Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. Currently, Tuesday, September 27th, coming towards the end of the business month, end of the quarter. Just at the end of the North American trading session, end of the daily candles for us Forex currency traders, roughly 5 p.m. Eastern time zone. Now, three things that I want to talk about before we start the webinar, before we get into the analysis. Okay? Number one, I'm pretty busy later, so I don't got as much time to roast or banter. So any trolls that come into the stream, because there always is some, you know what I mean? We attract that. Greatness attracts that, right? Any trolls that come into the chat, I'm going to let you guys handle it. I'm going to let the capital hungry soldiers handle that, right? Number two, all of us need to put our hands together right now, or at least have a moment of silence. Put your head down, and let's have a moment of silence for all of the asset classes and all of the countries that are absolutely getting hammered and murdered by dollar domination. So everybody, put your hands together in the chat, put your head down, put a 1 in the chat if you're going to show some respect to all of the asset classes, crypto, real estate, stock market, all these other countries, Euro, GBP. It's not football anymore, UK mans. It's soccer now. Euro people, we don't even give a shit about you. Y'all are dead over there. Recession, way below parity point. It's over. Emerging countries, all the small Asian countries, rest in peace. Let's give them the sign of respect. All right, quick moment of silence. Okay, now that shit's done with, the last third thing. Let's give all of us traders a round of applause if you've been playing the US dollar domination. If you've been following Capital Hungry over the last 6 to 8 months, you've been following the Federal Reserve rate hike cycle, you understand the dollar domination as the world reserve currency and how global economies are pegged to the currency. Let's get a round of applause in the chat if you've been selling GU, if you've been selling gold, if you've been selling EURUSD, if you've been playing dollar buys, if you've been shorting the stock market, analysis given ahead of time, market updates, higher time frame webinars, quick updates on YouTube, Twitter. Whew! It's been a run. It has been a run. Right? It's been insane. And the beautiful thing is, for people who have been following along Capital Hungry and understanding the lessons, you're not just playing the dollar domination blindly. You understand exactly piece by piece, starting from the cartel of the currency, why the dollar's been bullish, why other asset classes have been bearish. You know? But anyways, let's jump right into the market update webinar. We'll get straight into the value and information as well as knowledge here. So, some key fundamental points that are in focus. And we're going to do a bit of a more deeper dive breakdown and dissection on GBPJPY, as we had a lot more unique events take place in a very short period of time last week. And then for dollar pairs, for gold, for stock market, you guys already understand what we're looking to play. So recent fundamental points. US dollar domination continues. The Fed rate hike cycle is holding the most weight for global economies. We're seeing a lot of other countries suffering in terms of value against the US dollar, as obviously it's the world reserve currency, and majority of global business and overall economic systems are essentially rooted and tied to the US dollar. Some things we have to keep in mind, and some things we already noticed for anybody who was looking at GJ at the start of the week, or even dollar pairs, is that we had very, very heavy volatile movement. This is very common when you're coming towards end of business quarters or even some end of business months, and it's known as rebalance of flow moves. For example, you can see GJ had almost 700 pips of downside, which we're going to talk about in a minute, all the way to very key monthly and weekly demand zones at 149 and 150, where we saw a lot of institutional buy-side liquidity get collected, and of course a shift in the fundamental sentiment, which I'm going to break down step by step for you and my expectations of what's to come, right? So keep in mind some things in terms of market timing. It is coming towards the end of a quarter. It is coming towards the end of the business month. We have a lot of central bank speakers from the Fed, from ECB, Bank of Canada, Bank of England speaking this week. We have a lot of economic data on the docket this week. And some of the short-term catalysts that were impacting GJ in a negative fashion, bringing it down, such as the Japanese government currency intervention or the UK government tax cut plans, a lot of that information has been priced in. And we'll talk about that when we obviously look at GJ individually. So those are the key recent fundamental points in focus, what I'm looking at from a macro perspective and tracking day in and day out as we observe order flow movement in the markets. Psychology tips. Obviously, as we're coming towards the end of a business quarter and the end of a business month, at the same time, there's a lot of fear, uncertainty, and doubt in the markets. We're seeing global equity markets extremely bearish and whales liquidating positions. We're seeing dollar toppling emerging countries and toppling asset classes. It's bringing a lot of fear, uncertainty, and doubt to the markets. At the same time, we have countries in active recessions. So there is a lot of volatility. You have very aggressive movement where as a scalper, it can be very deadly if you don't adapt on the lower time frames accordingly and take your quick jabs at the market. So keep in mind, heavy volatility, start of the week due to market timing, end of Q3 rebalance of flow moves. Stay adaptive to volatile conditions with quick jabs at the market as a scalper or day trader. Stick with the main macro fundamental bias, or wait for cleaner market conditions that you feel a lot more comfortable to trade. Because even if you have analysis pre-planned, if you don't have the experience of trading high volatile conditions, or if you don't feel comfortable putting risk into the market during high volatile conditions, then you shouldn't enter at all. You should sit on your hands. Sometimes the best position to have as a day trader or scalper, depending on the market conditions you have to adapt to, is no position at all. Sometimes the best thing to do is sit on your hands, observe on the sidelines, and wait for conditions where you're most comfortable, where you feel the most confident based on your analysis, pre-planned expectations, and trade ideas. Market sentiment reading. Dollar domination continues as we tapped into 114, 30 to 35-year highs. Japanese yen is still bearish on the higher time frame. Now, I know last week we saw a surge in Japanese yen value where you saw a lot of yen pairs have an aggressive downside move. GJ, EURUJPY, AUDJPY, and so forth. This was due to currency intervention by the Japanese government, as the Japanese yen has been devaluing at a very aggressive pace due to the active rate hike cycle by the Feds and dollar domination, and the Bank of Japan keeping interest rates in the negative, and obviously a loose monetary policy as they're trying to accelerate inflation in Japan. For those of you who do not know, Japan's economy is a lot different, where they went through an economic collapse and an economic bubble pop during the late 1980s, early 1990s. What that did is put them through a stage of deflation where they had extremely low economic growth and economic activity and extremely strong levels of deflation, which is negative for an economy as well. So this is an explanation of why the Japanese central bank, Bank of Japan, keeps interest rates in the negative. They're trying to accelerate inflation and stimulate growth in their country compared to the other major central banks like Canada, Australia, New Zealand, the UK, the US, which sort of all just follow suit with the US and what the Federal Reserve's doing of hiking interest rates to combat inflation, right? So the Bank of Japan's overall macro sentiment of keeping interest rates negative, a loose monetary policy, an unlimited bond buying program going, and keeping stimulus going for their country to accelerate inflation on top of the Feds doing an active rate hike cycle and dollar domination, it's starting to have a lot of negative impacts on Japan's economy, in terms of devaluing the yen at an aggressive rate. So the Japanese government, which yes, the government works hand in hand with the central bank, but they are separate entities. The central bank's primary focus is all monetary policy, all about the money markets, all about the stock market, global business, and so forth. The government obviously has major focus in the money markets and greed and so forth, but they have to appease to the people as well, and obviously have to work with the overall citizens and people of the country, where the central bank doesn't really work with the people or even communicate or deal with the people at all. There's not that line of connection between the central bank and the masses. You have this connection between the central bank and the government, and then the government works in hand with the people one level below, right? So the government was just trying to appease to the public people, make it look like they're doing something to keep the yen a bit stronger, and they did some currency intervention. But all that did, when we look at the Japanese yen individually, is give a short-term upside squeeze, and overall, the Japanese yen is still bearish because the central bank holds way more weight, and especially the combination of what the Feds are doing. Okay? So let's look at that. Here you can see this was an aggressive spike up on this is the Japanese yen individually, the Japanese yen currency index. Obviously, we already understand dollar's extremely bullish, domination active, sitting at 30 plus year highs, printing new highs at 114.5. Obviously, we understand the volatility index is bullish, breaking out above intraday ranges as the equity markets are seeing massive sell-off, and there's a lot more fear in the stock markets due to the active rate hike cycle and hawkish aggression of the Fed. Obviously, we understand that overall, the Japanese yen is extremely bearish individually because of the loose monetary policy and negative interest rates of the Bank of Japan still keeping stimulus going for their country. But a lot of people were confused by this aggressive upside squeeze that you can see already got faded out. What happened here was as the yen was heavily devaluing and approaching its previous lows again, marked in the yellow arrow, the Japanese government, the top currency diplomat of the Japanese government named Kanda, K-A-N-D-A, they intervened, purchasing and propping up the value of the yen in the short term to try to alleviate some of the sell side pressure and try to alleviate some of the volatility of how fast it's been dropping. This was the reason you saw an aggressive spike down on pairs like GJ, EURUJPY, and so forth. Now, none of this is after the fact. If you're following the Capital Hungry Twitter, if you're following the Capital Hungry Telegram, you were getting these updates well as it was happening. And in the private channel, you were taking advantage live with the newsroom and all of our active updates that are sent in the private channel, right? But all that did was give a short-term upside squeeze to the yen, which we obviously saw with some downside on GJ, but all it did is lead to more sellers jumping into the market as this week and even into end of last week, the Bank of Japan further cemented their dovish policy stance, and the Japanese government also said that if they ever do any more currency intervention, it'll be limited and way less than what was taking place here. So let me break down all the chain of events that impacted GJ now and why it was so bearish and how it conveniently came down to a demand zone of interest. So for those of you who have been following GJ, obviously the higher time frame has been extremely bullish. You're looking at the interest rate differentials between the two countries. The Bank of England has been in more of a rate hike cycle and actively talking about rate hikes and so forth to come since mid-2021 onward. And the Bank of Japan has been keeping a loose monetary policy with obviously being very weak. We have a very, very strong institutional demand zone at 149 here that we haven't broken this price point in a very long period of time, right? Now, as we were failing to break significant higher time frame, higher highs, and we finally started to break this support area here, the reasoning for this downside move marked in red is going to be as stated here. We had multiple events take place last week. Some were pre-planned, some were reactive. 1, Japan government. Let me move my camera. So all this marked in red is the reason why we had such aggressive downside move. Currency intervention. right? So, one, as we're approaching the end of month and end of quarter, we had buyers liquidate positions from previous highs as we failed to break, and more sell side liquidity entering the market with the anticipation of events to come. We had the Japanese government do some currency intervention, bringing some individual yen strength. Then we also had the UK government and new government parties looking to come into play, talking about tax cut plans. Tax cut plans and anything like that is more to cater to the people and get more votes and people on your side from a political perspective. But tax cuts will always dig into the country's budget, or the money has to come from somewhere. So it's always a negative impact on the currency from a money perspective or from a financial market impact perspective. So the UK tax cut plans from a government perspective was more to appease to the people and more of a political viewpoint there, but it had a negative impact on GBP individually. So you had Japanese yen strength come into play with a reactive catalyst of the currency intervention. UK tax cut plans bring individual GBP weakness. A priced in Bank of England rate decision that brought individual GBP weakness, and the end of quarter price setups that we saw to start this new week that had us go from GJ 164 all the way to this demand zone at 148. Now we have to understand, for anybody who's not been following along, marked here in green, we had a huge bounce from 149 demand zone all the way back up to 156, almost 700 pips, still failing to break this very key demand zone, still maintaining macro GJ bullish structure. The reasons for that are as stated here from this week. So now, conveniently, the same reasons that led us to downside here, we had the same politicians, the same central banks reverse it as soon as we hit this very key institutional demand zone. So we had a higher time frame demand zone hit right towards the end of quarter to set up better price points. Then to start this week, the Bank of Japan, after their rate decision last week, brought more dovish remarks talking about sticking to their loose monetary policy. That led to the Japanese yen strength getting faded out. The Japanese government also came back this week and said if they do any more currency intervention, it's going to be limited and hold way less volatility. That canceled out that Japanese currency intervention move. And we had Bank of England speakers bring more hawkish remarks, increasing the hawkish potential for the next NPC meeting, the next Bank of England meeting. So all of the reasons here that led to this downside got politically or economically faded out by Bank of Japan remarks, hitting an institutional demand zone, the Japanese government reversing the same things they said here, yen strength getting faded out, and then the Bank of England bringing more hawkish remarks that brings GBP strength, right? So Bank of Japan dovish remarks, that weakens the yen. The Japanese government saying that the currency interventions they do in the future will be limited or less impactful, that also weakens the yen. The Bank of England bringing more hawkish remarks, that brings strength to GBP. Conveniently and surgically, as we hit that same demand zone that hasn't been broken since early 2021. Is that extremely interesting or no? So yeah, this downside was extremely intense, very high volatility. But it was due to these fundamental and real world events in combination, because all of these events were coming out during the same night. You had Bank of Japan, Bank of England rate decision, the currency intervention by the Japanese government, and the UK tax cut plans all in the same 24-hour period. It was a lot of negative volatility to impact GJ, and then that bled into the opening of the new weekly period for the end of the quarter as well. But as we hit this demand zone, and as we can clearly see, a lot of buy-side liquidity was generated here, and sellers exited positions, we're potentially coming back into a bullish bias because these events came into the table, fading out this catalyst that's also already been priced in. Right? So what does this tell us? What does this information tell us? Well, it tells us a few things and a lot of important things that we can use to our advantage. One, if we don't get any more Japanese government currency intervention, which they said they're not doing anytime soon, there's not really any more reason for yen strength. UK tax cut plans have been priced in. We're getting more hawkish remarks from the Bank of England. We're getting more dovish remarks from the Bank of Japan. We've also, at the end of the quarter now, and to potentially set up the new month, still respected this institutional demand zone at 149. Also, look at something very interesting, marked in green circles right now. Every time we revisit this demand zone, marked at 149, you actually have a technical rally to higher highs, if you haven't noticed that. Every single time this demand zone is retested, no matter how aggressive the bearish movement, you actually rally into higher highs as long as we don't break below that area. So if we don't have any new fear, uncertainty, and doubt, if we don't have any economic catalyst for yen strength, if the negativity on GBP has been priced in, if we respect this demand zone, we can expect a lot of buyers to be jumping into the market, especially into the new quarter, where even if we get a pullback for the new quarter to create what we observe as a lower wick, just more buy-side liquidity being generated, we can easily be making our way back to these highs and potentially higher. Does that make sense? Now, this is going to be a lot to take in. Look at this on the weekly time frame and on a previous historical bullish run, right? You can see this very strong institutional support level at 120. You can see this has been talked about in the higher time frame webinars as well. This is the exact same sequence of events that took place after the 2008 global financial crisis. Right? You can see it's very common, even from a historical perspective, that you can have aggressive pullback plays on GJ and still be maintaining the integrity of a higher time frame demand zone and, of course, bullish structure and historical repetition, where very similar to the optimistic run when the Bank of England started hiking rates again after the 2008 global financial crisis and the Japanese yen was still relatively bearish, you can see a very similar run in a very similar sequence of events as history continues to repeat day in and day out. If we can't break below that institutional demand zone, and if we don't have any new fear, uncertainty, or doubt, for the next quarter, we can easily see a price grab and still continue bullish to these highs. Right? Because economics and human nature always repeats, the technical patterns on the chart that we observe as retail traders are always going to repeat as well. Isn't that extremely interesting too? The same type of very strong bullish run. Then you can see marked out here in blue, you have this period of more order collection and generation, but you still end up respecting that demand zone, having another bullish rally to the upside. Right? So I just wanted to give that quick lesson on GJ that yes, we had this aggressive bearish downside move, but if we don't have any new fear, uncertainty, or doubt, if we don't correct this downside move and we don't break below 149s, there is a lot of potential for buyers to be coming back into the scene from a macro higher time frame perspective, right? Now, anyways, we're going to dive into intraday analysis and dive deeper on the time frames across all these pairs, but I just wanted to break down that chain of events on GJ so everybody understands what happened and why. And if you follow along Capital Hungry Resources and Information, then you were following those updates last week, whether in the Telegram, Twitter, Instagram, and so forth. Now, the other pairs, gold, GU, EURUSD, we know are bearish. That's easy. Dollar domination, active Fed rate hike cycle, less investment activity, buyers liquidating positions out of these asset classes, and sellers dominating. Gold is bearish, GU is bearish, EURUSD is bearish, the stock market's bearish. UCAD is obviously the inverse, as the dollar is the primary in this quote, and it's bullish. But GJ, that needed a little bit more dissection and a little bit more of a breakdown. So now, before we jump into the intraday analysis, diving into the more intraday time frame charts and so forth here across the board, we just want to understand what economic events we have on the table. So in terms of dollar pairs, gold, stock market, there's no reason for us to stop our sentiment yet. There's no reason for us to stop UCAD buys. There's no reason for us to stop EURUSD sells. There's no reason for us to stop GU sells. And there's no reason for us to stop gold sells. There's no Taiwan tensions actually escalating. There's no other catalyst in focus besides the Fed rate hike cycle and the central banks combating global inflation, or at least trying to. There's no other main impacting factor. US 30, there's no reason for us to be buying into the stock market. There's no signs of support. There's no signs of exhaustion. There's no fundamental catalyst to do so yet. Okay? Now, economic events before we jump into the individual pair analysis and trade ideas. These zones you see marked in white are based on higher time frame historical key levels, monthly, quarterly, yearly. Okay, economic data for tonight and tomorrow. So, September 28th, 1 a.m. Eastern, leading economic indicator for Japan, which is going to be the same expectations as prior. It'll probably still be relatively weak. 2 a.m., which can give a little bit of yen strength that'll end up getting faded out, or just yen continue bearish after a liquidity grab, which is the same thing I just said. I just said it twice in this different way. 2 a.m. Eastern, pre-London hours, consumer sentiment report for Germany. Euro's in a recession. Euro data's dog shit. Germany's economy is absolutely terrible. This is going to be bad data still, which can further support weakness in euro and us playing euro USD sells against the strong dollar. 2:45 a.m. Eastern, France, and then at 4 a.m. Eastern, Italy, both consumer confidence reports, both expected to show declines with less consumer spending activity and confidence in the market and their economies overall. So this is also going to lead to further potential euro weakness and potential euro USD sells continuing, especially if we break those lows. 10 a.m. Eastern, some pending sales change in terms of home sales for the United States, which is expected to decline as obviously the real estate market is dropping with every other asset class during this active Federal Reserve rate hike cycle, which creates less lending from institutions, less investment activity, less easy money, less investments into homes, stock market, commodities, gold, and so forth, which is why all these asset classes are bearish. Other than that, not much else going on. This is regular treasury auctions and so forth, normal daily procedures. Now, we do want to keep in mind that we have a lot of central bank speakers scattered throughout the night, through London session and throughout the day tomorrow. This is all of the central bank speakers just for tomorrow, okay? So, okay, 3:15 first, ECB, Christine Lagarde. She's going to be talking about geoeconomics and economies overall, so it can impact euro and overall market sentiment. 4:15 a.m. Eastern, Bank of England speakers talking about technology, potential to answer questions about financial stability, economics, and so forth that can impact GBP. 8:35 a.m. Eastern, Federal Reserve Speaker Bostic talking about leadership in banking and the economy. Just more of a different type of presentation about minorities in banking, but he can always get asked questions about monetary policy and outlook as they always do. 10:10 a.m. Eastern, James Bullard talking about economy and monetary policy and so forth. 10:15, this is a pre-recorded video of our boy Jerome Powell. No, that's not going to be too important. 11 a.m., Michelle Bowman talking about banking competition, finance, monetary policy. 11:30, Thomas Barkin talking in front of the Chamber of Commerce about monetary policy. 2 p.m., Bank of England MPC member with the Federal Reserve, Charles Evans. So a double whammy late day tomorrow, 2 p.m. Fed and Bank of England at the same time, same meeting, right? So you can follow the Capital Hungry Twitter if you're not in the private channel. There's going to be tons of headlines through London session tonight and New York tomorrow of central bank speakers giving their sentiment on monetary policy. The majority of them are probably going to be fairly hawkish, with their main focus being on bringing down inflation and continuing to raise rates and keep rates up for an extended period of time. Just a quick side note that a lot of people don't understand is even though we're seeing the rate hike cycle by the Feds impacting the money markets, as we've seen the Feds actively hiking rates over the last 6 months, right? Tons of rate hikes, huge impact on US dollar strength, and asset classes turning bearish. This is just step one. Remember, in life, in society, the game that we are programmed into, the money moves come first, right? Everything that we have seen with stock market turning bearish, with gold being bearish and dollar domination, is just the market makers, the whales, the institutions pricing in adjusting order flow for the rate hikes signals and the actual rate hikes that happen. But we have yet to see the real economic implications or impact of the rate hikes to the US economy. Rate hikes is not like a light switch. What is like a light switch is the market and market makers pricing in the rate hikes from the signals given by the Feds, starting to adjust order flow accordingly. But what's not like a light switch is the actual impact of rate hikes to the economy. You have to do rate hikes and keep rates extended for a period of time, 18 months or 2 years, before you finally start to see inflation come down, asset prices come down, goods of prices in the economy come down, with overall less economic activity, right? So even though we've seen 6 months of rate hikes, it hasn't even done a single thing to US inflation yet. It's just getting started. So they might do a couple more rate hikes, which is expected, and then they're still going to keep rates hiked for an extended period of time. So listen to me very, very carefully. The markets have priced in and adjusted order flow institutionally to the rate hikes and the signals of rate hikes by the Feds. But what the market hasn't priced in yet is the negative impact of rate hikes in this weak economy that's going to cause major economic downside. The real pain is going to come when people have to deal with high debt rates. Inflation's still going to be high because inflation doesn't go down instantly, right? You're still going to have people having zero disposable income. Wages and jobs will be stagnant. Less economic activity and growth. Corporate and stock market profits are going to go down. Whales are going to be sitting on the sidelines. No disposable income as stated. Credit card debt through the roof. Mortgage debt increasing. All of debt rates will be high. Cost of goods will be high. Buying power of the dollar for the people will be low. The recession's already active, but the Great Recession is still yet to come. There's going to be a very dark period where you have high debt rates, low economic activity, no investment activity, and still high inflation and cost of goods. But anyways, so those are the economic events and the political events on the docket. Now let's jump into the analysis. We're going to go through gold, GU, EURUSD, US30, and USDCAD first, because these are pretty simple in the essence that we have very clean bearish structure on gold GU, EURUSD, and the stock market, and very clean bullish structure on UCAD. Obviously, we understand that's because we're playing dollar domination. US dollar is extremely bullish. It's the world reserve currency. We have the Federal Reserve doing an active rate hike cycle, which keeps other asset classes bearish, like commodities, real estate, crypto, and any other investment vehicle in an asset class such as gold. And that's what we've been playing from a fundamental and technical perspective. When you're looking at the simple price action on the intraday time frames of dollar, there's no signs of slowdown yet. We're just starting to consolidate at these highs, and we're already just sitting back at the last highs, impulsive highs printed here. We're extremely bullish. There's no reason for slowdown. There has to be an economic catalyst for dollar weakness, especially for a long period of time. Yes, from a technical perspective, you can say dollar is due for a pullback phase, which is very common, but we've already had, before having this bullish run here, we already had this pullback phase and accumulation of sell side liquidity, both marked in the green boxes here, a pullback to collect buy orders from better price points, and an accumulation of buy side liquidity here, and a break and retest of those highs. We've already had very clean order collection on the buy side here, and a lot of buyer volume clearly in play. There's no real signs of a pullback phase starting to enter yet. Dollar domination is still very much active. We have higher time frame targets of going to 120s, right? So we still want to play Japanese yen weakness. We still want to play dollar strength. We still want to play stock market bears with the volatility index bullish and global equities in all countries extremely slumped over. And that's our main bias, just understanding some of the events on the table. When we're looking at gold and trade ideas on gold, gold is extremely, extremely bearish. If we were to have any type of pullback phase, we would need to be breaking well above the 1650s to see a pullback to the 1680s and further sell-off. I would personally only be looking for any type of gold buys well above the 1650s at this point. Dollar's too bullish. Other asset classes like crypto, stock market, extremely bearish. We can see as manual retail traders the weight, the fundamental catalyst of the rate hike cycle of the Feds, the weight it's holding with the order flow right in front of our eyes when you understand both sides of the coin, the fundamentals and technicals, right? So I can't even expect any type of pullback on gold unless we're trading above 1650s. I can't expect any type of pullback on GU unless we're trading well above 1.10. I can't expect any type of pullback on EURUSD unless we're trading well above 0.977. I can't expect any pullback on UCAD, we already had one, unless we were trading well below 1.355. This is just some minor intraday bullish structure. It's an overall extremely broad bullish structure, right? So with that being said, I'm still extremely bearish on gold. Now we are getting some minor signs of exhaustion as we haven't broken these lows at 1630, 1628 just yet. But at the end of the day, we still had at least sellers print new significant lower lows. We're clearly having a sell side liquidity area here being respected as 1648. So any pullbacks to these areas or breaks below the lows are still sells. I'd only be looking for deeper pullback buys on the higher time frame, well above 1650s as stated here. So the trade ideas for me on gold, the main bias would be a double top at 1642, even a deeper pullback to 48, breaks or flip back below 1628, and breaks below 1623, continue the sell side bias. I would personally only be looking for gold buys if the sells at 1648 are invalidated and we're breaking above previous significant lows, well above this sell side liquidity zone and well above 1657. And even then, I would take advantage of those buys in the short term to go revisit better sell zones on the higher time frame, which could be potentially a setup for the new quarter and new month. But we would need a catalyst to be breaking well above 1655s again. Now, this is going to be the same type of understanding in bringing that information together on GU. You can see for the time being, we're still not breaking above these key levels. We still have had sellers print lower lows. We're just showing a little bit of consolidation and ranging here. I can't expect any type of pullback buys, which is a secondary phase, unless we're breaking above 1.104 key level, clearing well above these rejection points, fading out a lot of this downside move, which that would be a secondary bias and just adapting to a pullback phase in the short term to retest better sell zones on the higher time frame. Otherwise, the main bias I'm looking for on the intraday time frames is even double tops in this area, holds of these key levels, breaks below these lows, just continue the sells. We still have low targets to revisit. GBP is still bearish against the dollar. We don't have any reason for dollar weakness. Dollar index is extremely bullish at historical highs. We still have very bearish price action in market structure. We're just showing a little bit of indecision because keep in mind, right? We had extremely high volatility at the very start of the week. GJ spiked to 149, then bounced to 156. Gold print new lows in the 1620s. Dollar pairs have this melt and dollar go to 114. So as we had that movement take place, now we're just seeing a bit of that volume and volatility slow down. That move got priced in, seeing a little bit of consolidation. What happens is for retail traders who only focus on technicals or don't have understanding of market waves, or of course various phases of market structure. Like for example, this is the impulsive move with market structure, continuing the trend. This is your secondary phase of market structure, a correction phase, right? A lot of people in these correction phases start to think reversals are going to happen. They start to try to guess a bottom. They start to try to guess a top in a very bullish trend. And you just get burned, you get trapped, right? You can consolidate for a period of time and still not show any signs of shifting structure. But you know how many retail traders who are only technicals say, oh, GU's at such lows. Oh, we're at March 2020 lows. Look, we're creating a support. But we have to get a reversal now. I'm going to buy. And they get slapped. Right? It's just that the market moves in waves. You're not always going to have continued downside or continued upside. You have transactions entering the market around the clock from around the world in terms of market participants from an institutional perspective. And these transactions create these market waves alongside timing, volume and volatility changes, different economic events coming to the table and so forth. Right? EURUSD, yes, we're ranging at the lows, but it's so bearish, right? It's extremely bearish and can drop even more. I'm not trying to call bottoms here without fundamental reasoning. Continue the main bias sell side. Double tops, revisits of this last rejection point sell side liquidity zone. Just a new daily pullback and failed to break 0.965 or the breaks below 958 continue the sells. I would only look for any EURUSD pullback buys well above 0.977, 0.98. You would need reasoning for euro strength, like extremely hawkish ECB confirms or a surprise higher rate hike by the ECB, which can give a short-term pullback, or fundamental reasoning for dollar weakness. Otherwise, that would just be short-term pullback phases to retest better sell zones. USDCAD. Extremely bullish. Nice intraday structure. Buyers printing higher highs. Deeper pullback to retest structure. Hold key level. Breaks above key level. Breaks above high. Continue the dollar domination train. It's not showing any signs of slowdown. We actually got even more hawkish remarks from Fed speakers today with Fed Bullard, Jerome Powell previously cementing what he said at Jackson Hole Symposium. And the Canadian dollar is relatively more weak as we have crude oil dropping below $80 a barrel, a lot more bearish on the intraday time frames, with that correlation of the Canadian dollar to crude oil making the Canadian dollar a lot weaker. One of Canada's main revenue sources is exporting of crude oil, right? So when oil's a lot more bearish, investors, smart money, the institutional algorithms, you see a lot of priced in movement on the Canadian dollar, and vice versa. When oil's very bullish, Canadian dollar has a bit more strength. So Canadian dollar is a bit more bearish with the Bank of Canada sentiment priced in, faded out. And of course, crude oil being more bearish with that correlation from an economic perspective, and dollar domination continues. Stock market. All my drawings got deleted on the stock market and all my levels, but we'll make do here. No reason for us to be buying equities yet at all. Revisitations of this sell side liquidity zone, even 30K, break below these lows, continue the sells. That is retest of 29.6, 30K flat, breaks below 29K flat, continue the sells. Stock market is extremely bearish, dollar domination continues, VIX is bullish, which now the VIX volatility index breaking above this intraday range and coming back to these 34 highs. It doesn't just show me more buyers exiting out of the market, it also shows me more short sellers entering the equity markets as well, and more panic starting to ensue. And you can see global stock markets are slumped over and extremely bearish. Last but not least, GJ now. So GJ is very interesting, where I could see some short-term downside only if we break these range lows to potentially set up better higher time frame buys. If we were to break below 153.8 here, right? If we were to break below 153.8, just to potentially set up the new month and new quarter, I could still see deeper price grabs and short-term sells to 150s before setting up better higher time frame buys back into the table. Otherwise, in the short term, if we just have a pullback to some of these PPLs in range lows here in this new daily candle at 154, or if we start to break out above these range highs, and especially if we break out above 156.8, I would be looking to jump back into the bullish bias on GJ. So only short-term potential sells or sells below 153.8, which would be driving down to potentially retest these lows, collect more buy-side liquidity before continuing bullish. Take a quick visual screenshot of this. Actually, you can rewatch it as you wish. Let me give you an example. You can see at this demand zone before, it is extremely, extremely common with how GJ behaves that even though you could get an initial very aggressive bounce from an area, you could revisit that area multiple times, doing triple bottoms, double bottoms, and still be extremely, extremely bullish. Does that make sense to everybody? So if we could easily see GJ still do another double bottom at 149 when we're looking at the current action of price here, just in a potential more aggressive fashion, when you're looking at this demand zone and you're looking at some of the sequence of events, remember these technical double bottoms, it's not just a pattern to follow. It tells you information about order flow, not having enough seller volume to break lower and more buy side liquidity accumulating in that area. If we saw something like this, it would not be out of the ordinary at all. But the only way I could sell down to revisit there is with those trade ideas shared on the intraday time frame, right? I would need to be breaking well below this intraday range that's starting to get created here, marked roughly in this yellow box. I would need to be trading below 153.8. Then I could see those short-term sell plays to set up better buys for the next month. Does that make sense to everybody? Clear cut, easy to understand. Otherwise, if we just come to the range lows fail to break, daily candle starts flipping bullish, we break above the range highs, safe above this last rejection point at 157, Japanese yen weakness continues. Bank of England hawkish sentiment holds some weight. I'm just going to be jumping back into the buys. Whew! All right, everybody. So, very informational filled session. A lot of value shared. We broke down key fundamentals. We broke down market psychology, higher time frame market structure, events that took place last week, price action, trade ideas, economic events that are in play, and so forth. This is going to be saved. You can rewatch it as you wish. If you guys enjoy these webinars and want them more often, make sure you send a like. I'm also going to be making a comeback in return this week or next week with one live scalping session every single morning, as not every single morning, but during a New York once or twice a week as well. Maybe on like a Thursday or something. Every Thursday we'll do a live New York scalping session. We might bring that back. All right. So you guys can rewatch as you wish. Send a like, subscribe, comment on the save stream to help with the algo. Share it around with all your other trading groups, friends and family on social media. Enjoy the free value. You guys know, let's be honest in the chat. No Miami guru, no paid mentor is giving you this much information when you pay them for an $1,000 course. How many people in this chat have paid for some cookie cutter course? Daniel Savage, Q Banks, some other Astro Forex, some other marketer or lifestyle marketer. How many of you paid $300? How many of you paid $500? How many of you paid $1,000? And do they give you this type of information? Probably not. So don't take it for granted. Learn as much as you can. Amrit, don't kill me. We all don't take it for granted. This guy said, I pay some guy named Raghav. Oh, good times, bro. Good OG times. Right? So don't take it for granted. Listen, dive into learning. Learn as much as you can. Don't be scared to learn. If you learn at a slow rate, that's okay. Learn as much as you can. Be more productive. Stop consuming so much mindless shit. Get off TikTok. Stop jerking off and stop going on porn. Right? And cut all that shit out. This guy said at least those guys prove they make money. Where's your results? You got chat, I'll let you handle this guy. This guy said proof of my lifestyle. I got a car around my neck. I just don't gotta flash it for the gram. You know what I mean? There's a vehicle on my neck right now. Pure Indian motherland gold. Just chilling doing a webinar. But you know what? I keep it hidden. I just keep it hidden. It's for me. Because you know what really matters? This is what's making me money. But anyways, everybody, you can rewatch this as you wish, and I'll see all of you next time. Just quit porn. Stop touching your dick. Yeah, like and subscribe. Everybody take care.